Why should you invest in stocks? Let me tell you a story of two people, Anil and Mukesh. Anil liked to keep his money in a fixed deposit, whereas Mukesh was very keen on investing. So he invested his money, say, in a mutual fund or an index fund. Anil kept 10 lakh rupees in an FD which yielded him 7% returns, whereas Mukesh kept it in a mutual fund which gave him 15% returns including dividends over time. Now fast forward, 40 years later, Anil has 1.49 crores, nearly 1.5 crores. But what about Mukesh? Mukesh would today have 25 crore rupees. Now, while you might say that these are just numbers, where can you get these kind of returns from? Let me just give you an example. Sensex in 1988 was at around 400 points. Today, it's nearly touching 80,000. But this does not even include all the dividends that the index has yielded. What is Sensex very quickly? Sensex is the top 30 listed companies in India, right? So if you would have invested 10 lakh rupees in the Sensex in 1988, today, including all the dividends and everything, you would have over 40 crore rupees because it has gone up almost 300 to 400 times if you include all the dividends and all the corporate actions. That's incredible, isn't it? That was just for the Sensex. If you include individual stocks have gone up more than 1,000 times in the same period.
But Yash, what is a share though?
That's a great question. A share is basically a very, very small part of a company. It could be 1 by 1,000th part, it could be 1 by 1,000,000th part of a company or so forth. Let's say you are an owner of a company, Satvika, and you have two ways to raise money for your company, right? Either you could take a loan from a bank or you could sell a very small part of your company, right? Now, when this very small part is offered to a whole lot of normal investors like you and I, it's called an IPO, which is an initial public offering. The company goes on to sell some of its shares, or some of the promoters, which are the owners of the company, go on to sell some of their shares in this company. And when it's done, it's called an IPO, which is again an initial public offering. Once you receive these shares, you can buy and sell them on a daily basis. In fact, even on a minute basis, right? Now that right there is a share.
But price of share changes every second. Why does that happen?
So let's look at it from two perspectives, short term and long term. In the short term, the price of a share is totally determined by the supply and demand for that particular share at that particular price. If more people want to buy it than sell it, the stock price will go up. If more people want to sell it than buy it, the price will obviously go down. But over time, in the long term, if you really think about it from a 10-year, 20-year horizon, the only factor in the long term that dictates the price of a stock is going to be the growth and profitability of that company. If the profits of that company are constantly going up, then the stock's price will also constantly go up.
Okay, so how do I start investing?
So you basically need to have a PAN card to begin with. And since you're an Indian citizen over the age of 20, I'm assuming you already have a PAN card. Post that, you need a demat account. Now, how can you open a demat account? There are hundreds of platforms now. I personally use ICICI Direct, but you could use Zerodha, you could use Grow, Paytm Money, and there are a bunch of other fintech and traditional banks as well that have their own demat accounts. You just need to open an account at one of these, and once you have that, you can start investing.
Okay, so how do I select stocks to invest in?
I personally believe, and for that matter, my belief actually coincides with that of Warren Buffett as well, that unless you want to actually pursue investing full time and you actually love analyzing businesses, you should not actually invest in individual stocks, but you should invest through a mutual fund or an index fund. Now, what is an index fund? An index fund is basically a fund that tracks the broader index. Now, what a broader index is? If you've been watching my videos either on Instagram or my YouTube shorts, you would already know what an index is. But just for information, index is basically the top X number of stocks in any certain sector or the country. For instance, Nifty 50 comprises of the top 50 stocks in the Indian markets. S&P 500 is an index in the US and it tracks the top 500 companies in the US. So similarly, an index fund blindly copies that particular index which it is a part of. Now, index can be specific to a sector as well. Like there is a Nifty Bank index which contains the top Nifty banks. There is Nifty PSU index which tracks the top PSU stocks and so forth, right? You can keep your money in an index fund, or if you want your money to be managed by professionals, you can keep it in a mutual fund. A mutual fund is basically a fund wherein professionals manage your money and they select the stocks that would be a part of that portfolio and they charge you approximately 2% management fee for the same service.
So is there a difference between trading and investing?
Yes. So trading is when you're speculating on the price of a stock going up or down. If it goes up, you probably make money. Or else you could also short a stock, in which case if the price of the stock goes down, you make money. These are usually carried out for a very short term. So it could be an intra-day trade wherein you buy and sell your position on the same day. It could be multiple times in a given day, which is usually done by a lot of high algorithmic traders. And lastly, you can also have swing trades, which can last up to a couple of days or even weeks. In the case of investing, you're not really speculating on immediate action on that stock. You're thinking about it from a very long term perspective as to what's going to happen with that stock or that basket of stocks over, say, 2 years, 5 years, 10 years, 20 years. According to Warren Buffett, the best horizon to hold a stock is forever.
So Yash, on Instagram, a lot of people look at these charts. What are those?
Those are basically they're trying to predict based upon the chart patterns and so forth. They're trying to predict what the stock might do next. A lot of people, again, like Warren Buffett, think it's full of shit. They really believe that to be bullshit. And I fall in the same club. I've never, for that matter, really looked at charts a lot because when I invest, I'm purely investing from the basis that the stock might do well purely because of its future profitability. So I personally don't have a look at charts. If you want to invest, you don't need to look at charts. Maybe if you want to be a trader, an intraday trader, it might make sense for you to start looking at charts. But that is not what the vast majority of people anyway should be doing. The vast majority of people would be much better off putting their money in a mutual fund or an index fund.
Okay, so where should I put my money?
In my opinion, ideally what you should be doing is an SIP, which is a systematic investment plan. In the US, it's also called dollar cost averaging. So what you're doing here is that you're investing a fixed sum of money on a monthly basis or on a periodical basis in a set mutual fund or a list of mutual funds. This is ideally going to be the best thing that an independent person can do unless and until they actually want to start analyzing businesses. This is the best approach they can take. And honestly, analyzing businesses is not for everybody. Everybody should not even try doing it because it's almost like a full-time task. So for the average person, you for that matter, Satvika, should put your money in an SIP and do that over a regular basis, irrespective of how the market is behaving, whether it's going up or down. You should consistently do that over the years.